This is the Nedgroup Investments Podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you.
Hi, I'm Trevor Garvin, Head of Multi-Manager at Nedgroup Investments. Each quarter, we have a look at both global and domestic markets and key events that are affecting investments. Here is the latest update. We hope you find it useful. International market commentary for quarter 3 2019. After a strong first half to 2019, markets took on a more nervous tone during the third quarter. August in particular was a difficult month, with riskier assets sharply underperforming safe haven assets. However, better performance in the months either side of August meant that most asset classes still managed to finish the period in positive territory despite the intervening wobbles. Economic data releases continued to point to slowing economic growth and arising recessionary risks in a number of economies. Manufacturing and trade data were the main areas of weakness, with many economists pointing to the ongoing US-China trade war as a key causal factor. Expectations for interest rates declined over the quarter, and in an attempt to arrest economic slowdown, most central banks, including the US Federal Reserve, European Central Bank, and People's Bank of China, eased monetary policy, with more to follow over the coming months. Trade relations between the US and China were never far from the headlines. Early in the period, relations seemed to be in free fall, with threat and counter-threat. However, in September, the tone turned more conciliatory, as both sides suggested progress was being made ahead of the formal resumption of talks in early October. Consistent with this improvement, Donald Trump chose to delay the next set of tariff increases from October the 1st to October the 15th. In other news, Nancy Pelosi of the Democrats successfully pressed for the commencement of impeachment proceedings against Trump over his ill-judged phone call to the Ukrainian president. Elsewhere, the UK House of Commons voted in favour of a law that supposedly takes a no-deal Brexit off the table should negotiators fail to strike a deliverable deal ahead of the October 31st cutoff. Over the third quarter, global equities were flat, up just 0.1% when judged using the MSCI All-World Country Index in US dollar terms. However, this masked increased volatility and dispersion across markets and regions, which was driven largely by shifts in currency exchange rates. A further downward adjustment in interest rate expectations underpinned strong performance across fixed income markets. High-quality sovereign bonds led the way, with the JP Morgan Global Government Bond Index up plus 3.1% in US dollars. A modest widening of credit spreads meant most other types of bonds slightly trailed, with the Merrill Lynch Global Investment Grade Bond Index up 2.7% and the Merrill Lynch High Yield Index and JP Morgan Emerging Market Bond Index both up 1.3%. The foreign exchange markets were very active over the quarter. Amongst the major currencies, the US dollar and yen were particularly strong, whilst emerging market currencies were generally quite weak. Against the dollar, the yen slipped minus 0.2%, the euro 4.2%, the pound 3.3%, and the Chinese yuan minus 4.1%. More dramatic moves included the Argentinian peso, which was down 35%, the South African rand down 7.5%, and the Brazilian real down negative 0.86%. Quarter 3 2019 Domestic Market Commentary. The roller coaster ride continued for local markets, with both positive and negative months this quarter, as markets are reflecting the high levels of uncertainty, both locally and globally. The South African Business Confidence Index, compiled by the Bureau for Economic Research, fell to a 20-year low this quarter. 4 of the 5 sectors showed a decline in confidence, with only the motor industry indicating a slight improvement in confidence. National Treasury released an economic policy paper in August which sets out a blueprint for growth, enhancing reforms over the short, medium and longer term. While the document draws from the National Development Plan, it has already been met with resistance by various agents in the political sphere. The Finance Minister used the opportunity to mobilize support, seeking feedback from the public and stakeholders by mid-September. Although most of the proposals are not new, the document is clearly a call to action on reforms that are desperately needed to revive economic growth. The government also published the National Health Insurance Bill in early August, which outlined the phased rollout of universal health care for all South Africans by 2028. Although improved access to health care is clearly an imperative for the country, there remains outstanding questions as to the services that will be available under the plan, the ability to fund anything beyond the most basic of service, and what role private sector medical aid schemes will play. The South African Reserve Bank acknowledged a contained inflationary backdrop and cut interest rates by 25 basis points in July, providing much-needed, albeit modest, relief to consumers. This was followed by the unanimous decision by the committee in September to keep interest rates on hold. This was broadly in line with market expectations given the significant event risk from the medium-term budget speech and Moody's ratings review, all scheduled before the next Monetary Policy Committee meeting. Provisional budget data for this tax year suggests continued underperformance in tax revenues, with expenditure, although largely contained, increasing due to additional support for struggling state-owned enterprises, SAA and Denel. The rand, which spent most of the quarter above the 15 rand to the US dollar mark, depreciated by 7% against the dollar over the quarter. Local equity markets were lackluster in September, edging up 0.2% over the month, with quarterly returns down minus 4.6%. Property sector financial results reaffirmed a challenging environment, resulting in guidance for meagre distribution growth at best. The sector lost minus 4.4% over the quarter, leaving it the worst performing domestic asset class for the last 12 months at negative 2.7%. Bond markets continued to price in a challenged fiscus, but managed to gain 0.5% over the month and 0.7% for the quarter. In one of the largest and most anticipated local corporate events, Naspers listed its international internet assets via a new entity called Prosus on the Euronext Amsterdam exchange. The majority of local investors exercised their rights to take up shares in the new listing, adding another offshore-focused counter to the Johannesburg Stock Exchange. Thank you for listening. We look forward to updating you again next quarter. For more information about the Nedgroup Investments Multi-Manager funds, please visit our website, nedgroupinvestmentsmultimanager.com. All the information on all of our funds is available on this website. Thank you.
Nedgroup Collective Investments is an authorised collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.